Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Well, hello there, everyone, and welcome to another issue of thementorpodcast.com. I have with me today Mr. Joe Viery, who is going to get you a bunch of tax deductions if you have any houses or intend to buy any that most people have no idea about. So, Joe, tell us, what do you do? Who are you? And we're going to get right to your questions.
Very good. Hey, Ron, it's good to see you. Thanks for having me share this information. I've been doing cost segregation since 2007. I started my own business about 7 years ago. And very simply, what all cost seg is, it's complicated, but the elevator speech is basically we accelerate the depreciation expense. Mm-hmm. It's the time value of money. Would you rather have the deduction today, or would you rather wait 27 and a half years and get a little piece of that deduction?
Mm-hmm. Yeah.
And obviously the answer should be we want as much deductions as we can get in today rather than waiting. And that's basically what we do. We're in a situation where we're right now the government, the IRS is phasing out bonus depreciation. I don't consider that a big deal because I grew up without bonus depreciation. But still it is a factor. We still are in bonus now. So now's a good time to accelerate your depreciation.
All right. So what you do is, well, most people think that what you do, if they even know about cost segregation, is about big commercial buildings. You're going to discuss today about houses, which many of our listeners here have or intend to get. Some of them have a lot of houses. So this will be a very important session for them. That's big money. So, cost segregation means what? You just rip a house apart and decide which parts of it that you can accelerate the depreciation on?
Great description. Yes, that's what we do. What we do is we kind of reverse engineer a house. Our team is made up of engineers, and we go and we look at a building and we reverse engineer it. We break down all the building components into the appropriate class lives that the IRS assign. So inside of the building is 5-year property. The outside of the building is 15-year property. And then you always have the main chassis of the building, the roof, the foundation, the walls, the windows, the doors that remain in 27.5-year property. So what we're in essence doing, Ron, is we're just, as a rough number, we're accelerating about 25% of the building basis. And that 25% is what gives them the advantage in their tax deductions. One note is that we do all types of buildings. I've done $500 million commercial buildings, but right now, because we're one of the few that do a really superior job doing the smaller buildings, we just found that there's so many people out there that have not done cost seg because it used to be the fee got in the way. Well, nowadays, the fee does not get in the way. So a lot of people who find out about us, their eyes get wide open because they want these deductions.
Yeah. Well, who wouldn't?
Who wouldn't? Right.
It's just one of those ways that you can reduce your taxes legally that most people have no idea they can do, especially homeowners. I mean, I didn't even know it until I interviewed the last time. In fact, I probably got a couple, 3 that you ought to do for me now that I think about it. I had my buildings done, but I didn't have my homes done, didn't know. All right, so what kind of things in this house are you going to pull out of the house and put a number on to accelerate depreciation?
Exactly. Good question, Ron. So basically what we do is we do it now. The reason why we can do it for inexpensively is because we've developed an analytical method. So I started out with doing the detailed engineering, and the detailed engineering meant that we would go out and see each property. Well, obviously, if somebody has to go out to a property and they have to make all the calculations and measurements, and they have to take pictures and document the property, that's going to cost money. And today, detailed engineering costs pretty much figure thousands of dollars. But what we do is we do it all analytically. And what we're looking at is we're looking to see the construction of the building. So on the insides, we're looking at the flooring. We're looking at the cabinets. We're looking at the countertops. We're looking at the window coverings. We're looking at the appliances. We're looking at specialty lighting, and that's the secret sauce, because obviously every building has lighting, but not every building can be put in, not every lighting can be put in 5 years. Who knows how to put all of these components in the correct classes? It's an engineer who studies cost seg and is experienced and knows construction. So that's the inside. The outside of the building, we're looking at land improvements. Well, what are land improvements? We're looking at what landscaping, anything you plant, lawn, trees. We're looking at fencing. We're looking at patios. We're looking at pools. We're looking at driveways. We're looking at specialty lighting and irrigation, and all of that goes into the 15-year. So if you combine the 5-year inside, the 15-year outside, with the 27.5-year main chassis of the building, which always stays in 27.5-year, in essence, when you blend all those together, you get the acceleration effect. And it's about 25%. So I can give everybody an estimate, but if you want to take your building basis, which is simply what you paid for the building, not what it's worth, what you paid for it, and you deduct the land from what you paid for it, that's your building basis, and you take 25%. So you figure you're going to get out $100,000 single family home. We're going to give you a $25,000 tax deduction. Pretty powerful.
Tax write-off, you mean?
Write-off, right. Deduction write-off, right.
Which at a 25% bracket is what? I don't know, about $6,000 or $7,000 a year in taxes that you save that you don't have to pay. I have a hard time getting people to clearly understand that. Yeah, it's about keeping as much money out of the hands of the IRS as you possibly can legally, and I'm all in favor of that. Trust me. I do everything I can to reduce my taxes, but I still have to pay taxes, a ton of them.
Well, Ron, as you know, that's one of the advantages of real estate. I'm at a conference in Dallas, and I just had a friend of mine who is pretty well known in the industry get up, and he has a $15 million of NOL, which is losses. So he's banked his losses. Why? Because he's a big guy. He owns 100 million in real estate, and he knows that the losses are losses. You want losses. So if you're not paying income tax, I could see you waiting until the IRS says your accountant says write a check. But for the most part, everybody should be doing accelerated depreciation, because it's the way the IRS wants you to do to calculate depreciation. So is it legal or not? It's so legal that I don't even need to beat that drum anymore.
That reminds me of when they were picking on Trump about not paying much taxes. What people don't understand, that's because he's got all these big buildings, billions of dollars worth of stuff that he does get all these write-offs on legally. So he pays taxes one way or the other. We all do. Yep. Do you have to go into the home, or do you do it electronically?
When we do it, when we do the analytical, or what we call the modeling study, no, we don't. We have to gather the information, though. So in other words, we don't make up stuff. We don't go to we're not part of that school. So what we'll need to do is we'll need to see what we can gather online, because there's a wealth of information. Yeah. We've got photos, we've got Zillow, we've got Trulia. Then we'll ask the client, hey, can you send us an appraisal? Again, a wealth of information. And if worst case scenario, then we may ask the owner to go out and take pictures. Just not many, but just let us know what's on the outside of the building. What do you have? What kind of land improvements? Go on the inside. Let us know what kind of flooring you have, and let us look at the kitchen and the cabinets and the window coverings. And basically with that information, which is very little time from our clients, we do everything remotely. So our engineers work remotely. We provide a study. We defend our work. I know that there's some of my competitors out there that either charge extra or just don't defend their work, but we're very happy to tell the IRS our methodology, because like I said, our methodology is so strong that, we don't mind talking to the IRS and sharing with them.
What do you charge for this service on a house, Joe?
Okay, there's two types of studies we do, and I think I can make it easy. There's a current year study and a look back study. Now, what's the difference? Well, the difference is on a look back study, if you bought a building, we're in a little weird area right now because if you're on extension, you're still in 23 tax year, right? You're going to file your taxes September, October. So you're in 23. If you filed your 23 tax return, then you're going to use cost segregation next year for your 24 taxes. So a current year study. So if you're 23 on extension, that's a current year study. We charge $625. For a look back study, you already have filed the first year taxes on the building. You have what's known as the federal tax depreciation schedule. And basically, if you have the federal tax depreciation schedule, then we have to do another bit of math to tell the IRS, this is the depreciation we took when we first bought the building. And by the way, Ron, we can go back 15 years.
15.
So we go back and we calculate it. How much depreciation did you take? Now somebody has to do the math and say, okay, now I'm going to accelerate the depreciation. This is the depreciation I've taken. And so we do that heavy lifting. We do the math involved. And then you have to file another form called a 3115 that tells the IRS, here's the math involved and here's the new depreciation amount for the tax year you file cost segregation. So therefore we charge $50 more. So we charge $675 for a look back study.
That's cheap, man.
Yeah. Again, when I first started doing this, Ron, I mean, seriously, my lowest cost building was a $25,000 building in Alabama. And bottom line, it still worked. Nowadays, you can't buy the low end of the bucket is what, 75, maybe 100. So therefore, anybody should be looking at cost seg. The fee is not a factor.
Correct. So if I'm out there and I got a whole bunch of houses, I mean, this could mean a lot of money, a lot of money. I'm just thinking, let's say we bought a house for $300,000 and it makes no difference how we bought the house.
Nope.
Then
not at all.
You can get about 25% of that. So that's $75,000 worth of write-off, which could easily turn into $25,000 worth of taxes saved.
Yes.
Yeah. Wow.
Yeah.
Well, anybody that's got property, and this does not apply to one's home, does it?
No, it does not apply to your primary residence, only investment real estate.
Okay.
But one thing we talked about last time, Ron, which I think it bears to be brought up again, is that one of the reasons, like I know all of the objections to cost segregation, and to be honest with you, there are very few that play out. There are certain circumstances where I will advise somebody not to do cost segregation. But one of the questions I always get is depreciation recapture. Well, why would I do cost segregation if I just have to pay it back? And I'll give you the answer. Because if you're a savvy investor and an accountant, then basically cost segregation reduces depreciation recapture. So I will nip that in the bud and say that is not a reason not to do cost seg. You still are going to have to pay some depreciation recapture, but my work will reduce your depreciation recapture. So if anybody's thinking that's a reason to not do it, I just quash that reason.
Yeah. What if I'm going to exchange my property?
Well, if you're going to exchange your property, you want to do the cost seg before you exchange the property. Because when you do an exchange, the relinquished property is folded over into the basis of the new property. So if you it stays in the method of what you used when you bought the building. So obviously it's going to be straight line. So if it's straight line depreciation and I make up numbers, you sell a building for $500,000 and you that $500,000 will stay in straight line. I can't touch it. So it'd be great if you did cost seg before you sold the building so that we can preserve your accelerated depreciation. Because once you do the exchange, it stays in straight line forever. I cannot touch that $500,000. So here's the issues with exchanges. If you exchange up, then I can, and you're using straight line in the building, you didn't do cost seg, then basically that's frozen. And we'll use the same example, $500,000, and now you buy a new building for $1 million. I have $500,000 to work with. So I'm going to say yes. cost seg will work. But if you trade up and you sold the building for 500,000 and you didn't do cost seg and you buy a new building for 575, I only have $75,000 to work with, then I'm probably going to say it may not be worth it. So obviously it's really in your best interest to do cost seg on all your properties if you're thinking of ever doing a 1031 exchange.
Joe, many of our listeners here on this have seen me do a 1 house to 3 house exchange, and we take the money out of the first one and we use it for down payments with seller financing on the other 3. So there's no reason I couldn't cost segregate those other 3 when I do that.
No reason.
Totally eliminates the tax on the first one. But what happens to the cost segregation after the first one's sold, though? I mean, how does that affect? Doesn't affect the buyer at all, does it?
Does not. No. It only. Yeah. No.
Well, then the buyer could actually have you do another cost segregation on it if they wanted to, if they knew anything about it.
Of course.
I got it. Okay.
Yeah.
Well, so how long does it take to get one of these things done?
Basically, it depends on the time of year, but we like to use the mantra that once we get all the information, so whatever it is, if it's documents, we have the documents. If we ask for photos, we get photos. We say 30 days after we get all the documents. The reality, Ron, is that, we can turn these around really quickly. If somebody needs a study within a matter of a week, we can turn it around. But we don't like to be pressured because it just helps us to say 30 days from when we get started.
Yeah. Okay. I get it. All right. So, I had a question right there, Joe, and it went away. Okay.
That's okay. They'll come back. I think I see it behind you.
You think? Okay. Well, I don't know what else to ask you, sir. So,
well, let's see. I'll tell you, here's something, people do ask me, remember all those objections that I've seen and heard them all. I will tell you, though, there are certain times not to do cost seg, and I like to be transparent. One of the foundations of my company, which is U.S. Tax Advisors Group Incorporated, or USTAGI, is that our playbook, our mantra, what we built the business on, is the audit technique guidelines for cost segregation published by the IRS. This document anybody can find online, ATG for cost segregation. And basically it's the Bible. The IRS is telling their agents what they need to look for in a cost seg study. So obviously that's what we base all of our work on, is what the agents are going to look for if they do have any questions. So people ask me, well, then who would not do a cost seg? One, we already mentioned, a 1031 exchange that's an even exchange or just a little bit of a tick up. There's really not much meat on that bone unless you've done cost seg for the building you relinquished. But most of the time, the answer is no. So that's number one. If you did exchange a building, that might be a wrinkle. The other one might be passive versus active. And your listeners probably know the term, but what the IRS did in the 1980s is they had doctors buying really junky, crappy buildings only for the depreciation expense to offset their income as a physician. And the IRS said, no, you can't do that. So they created the passive active rules. So bottom line is, if you're not an active real estate investor, meaning that you spend 750 hours per year on real estate, that means you're a passive investor. I have a lot of passive investors as clients, but I will tell you that, it just depends. So what I suggest is they get the estimate from us, which is a no cost free estimate. Get an estimate, take it back to their accountant, and then ask them, hey, look, Joe is going to give me the example we had before, $75,000 in depreciation expense. I'm a passive investor, Mr. Accountant, should I do it? Like I said, a lot of times accountants will say, yeah, you should do it. It may take you 2 or 3 years to go through the bucket of losses, but if you're planning on holding the building, do you care? No. So it just depends on your situation. I'm not a tax accountant, and we don't give out tax advice, but that's a situation where you'll want to take it to your accountant and just say, hey, look, should I do this or not? And if the answer is no, I agree with the accountant. Don't do it. So that's the only 2 areas where I would recommend people don't do cost seg. But it's so few and far between, Ron, that I think that everybody should at least get the estimate and find out what kind of money I can save them.
Yeah. Okay, good. Let's go back to the inside of the house for a minute.
Okay.
What items in there are you going to accelerate depreciation on?
Flooring.
Flooring,
All flooring except for ceramic tile. That is
except,
permanent. That's a permanent. So ceramic tile I can't touch, but any other type of flooring we can accelerate. We accelerate appliances. We accelerate, and a lot of times, what the investor doesn't know, Ron, is that what you pay for a component at Home Depot is not what the engineers how we break it out. It has nothing to do with the cost of a roof. So when you buy a building, the roof is baked into the basis of the building. All of these components reflect their allocation to the main number, the $300,000 you brought up. Part of that is a roof. What do? We break that all down. So now you get a report from us where you'll see what part is roof, what part is flooring, what part are cabinets in the interior. And so bottom line is what we can do with that is you get the recipe for the flooring, and you know what the flooring costs, and you know what the appliances are. Again, the appliances aren't what you buy a dishwasher from Home Depot. That's not what it costs. The appliances are all part of what you bought. So we have to carve out the appliances. So the appliances, specialty lighting, you have chandeliers, you have track lighting, you have spot lighting, meaning that the main lighting in the building, like if you have, let's say, lighting fixtures, like a fluorescent, lighting fixture, and it's not a spotlight. Well, that's two different kind of lighting in the interior home. So one of those is specialty lighting. One of those is the main lighting. So our engineers peel off the specialty lighting, and then we do window coverings. That's the main. Those are the main items we find in the interior. Cabinets, of course, and like I said, appliances.
okay. Joe, I believe it was you that told me that as I think of October last year, anything in there that's energy efficient, like ACs and windows, is actually going to be a tax credit. Is that you that told me that?
Yeah, as a matter of fact, what, we should do another talk with my energy engineer. And the reason I like to talk about the energy tax credits, it's called 45L. And basically what 45L is saying, that if you, like, a lot of your investors are probably value add investors, or they buy a building and they go in and they fix it up. Well, what do you do when you fix it up? You do maybe a new HVAC system. You're doing new LED lighting. You're doing maybe new doors, new windows, new roof, new insulation. If you can increase the energy efficiency by more than 50% over the threshold, which was a threshold that was designated in the year 2007. So if you go over that threshold by 50% and you increase your efficiency, today you can get a tax credit. Now, this is not a deduction. This is a credit of between $2,500 to $5,000 per door. And most accountants and taxpayers just ignore it. They do not understand what the energy tax credits are. And you can go back 3 years and take those credits. So if you flipped a home, you can go back. If you did the work, and you can tell my engineer what you did. Now, of course, we don't make stuff up. So you're going to have to tell us what kind of HVAC, what kind of insulation did you put in? If you don't have that information, we can't do the work. But if you have that information, even if you sold it 3 years ago, you can go back and you can get the tax credit.
No kidding.
Pretty powerful.
So how do we go about doing that?
Again, if you go online and get our link that takes you to the energy tax credits, we will ask you for the information on the improvements, and then my energy engineer will get back to you and let you know if he thinks you're going to qualify. I will tell you one secret. If you did replace the HVAC, you're almost all the way there.
Okay.
Not quite, but nobody just replaces an HVAC. You'll do something else. And so if you do replace the HVAC, that alone will get you over the 50% threshold, because, Ron, you can't buy an HVAC unit nowadays that's not energy efficient. They just don't sell them.
Okay. What about roof?
Same thing. Roof and insulation.
Oh my God. All right.
Doors, windows, All of that goes into the calculations. So this type of study gets a little complicated. And again, I think it would be great to have my energy engineer on the call. But bottom line is, I've just given you the recipe. All they need to do is fill out the link for the energy tax credits, and then we'll get back to them and we'll let them know if they've done enough to qualify for us to tell them that they will qualify.
Do you have a form that we fill out?
Yeah, what happens is you will get a link from Ustagi, and the link will take you to our website, and it's an inputable form.
All right, good. Give me that site again.
Pardon?
The website.
At thementorpodcast.com/COSTSEG, COSTSEG.
So in other words, we need to go back up to 3 years, figure out how many houses that we renovated, and then fill out a form for each one of them for you.
Yeah, and I think the easiest way to do is fill out one form and just let us know what you I mean, because most owners have a recipe. And so if you could just give us one, like, what's your recipe? This is normally what I do. Then basically, instead of doing, 50 or 30 or 20, do one and let us see. Do we think you're going to qualify? And then if you do qualify, then let's do the rest of them. Fill out the form. And again, this part is a no cost part of our process.
No kidding. So, man, somebody in the rehabbing business could stand to save a ton of money here on taxes just by doing that.
Yes. I mean, this is per door, Ron. So $5,000 per door. Yeah. If you have a 12-unit building or a 4-unit, duplex, quad, you're talking 20 grand and not deductions. This is tax credit means the 20 grand just comes right off the top of your taxes.
That's right.
You owe 100,000. Now you own 80.
I love tax credits.
Yeah. Everybody should.
I'm going to do just exactly that. So you can be expecting to hear from me. But I'm thinking about rehabbers. Like I know some people do 25, 30 houses a year rehabs. And I bet they don't know about this.
You know what? I've been doing this since 2007. And I tell you, these energy credits have been around for a while. The problem is the IRS made it so damn difficult for people to even figure out what the heck to do. Then in 2022, I believe, they came out with a new update. And so instead of making it year by year, they put this in law for 10 years and they clarified the rules of the game. So now it's crystal clear how you do this for my engineers. So bottom line is most accountants just don't even know about the tax credits, or they don't know who can do them.
Yeah, well, I can believe that. I'm in the business and I didn't know it. So that's why we interview you. So
yep.
In fact, I might take this podcast and just send it out to my whole list and let them know.
Yeah, well, they should, because, that commercial that's on TV that they don't know they're sitting on a pile of money. A lot of people in real estate, because you need to have a good quality group like you, Ron, that can help investors. And that's what I tell people. I said, surround yourself by knowledge. So what does that mean? Get a good accountant, because your average accountant who has clients from Home Depot or Costco or whatever, they don't know about real estate, and they don't know about 45L tax credits. And that's the problem. Until they find out from me, the light bulb goes on and they go, oh, I should ask my accountant. Then the accountant calls me. He goes, what are you talking about? What's a 45L? And then we educate them, and then we're off to the races.
Well, that's good. All right. Okay. Is there anything that I should have asked you that I didn't?
I think we covered it. We did a good job, Ron. I'm glad one thing that I will explain is that we are in the declining era of bonus depreciation, but Congress already passed the extension that's hung up in the Senate. So what's that mean is that, once it passes Senate, then we're still back to 100% bonus until 2027. Which will be nice. Is it critical in my opinion? No, because like I said, I grew up without a bonus depreciation. But anybody out there that didn't want to do cost seg because they knew that for tax year 24, it's now 60%. And what that means is simply you get the bang up front of 60%, and then the 40% you get in residuals over the next couple of years. That's all it is. It's just a timing issue. You're still going to get the bang for your buck. It's just going to take you 4 years to get all of the benefit. Back in the day, everybody knew that. It was not a big deal. So I just want to leave everybody knowing that hopefully Senate will pass this bill, because it's just languishing in the Senate because of politics. Once they pass it, then it'll be back up to 100% bonus. So just stay tuned. Talk to your financial planners, because when this tax bill passes, if that is your decision, you wanted to wait until bonus is back. Well, I expect it to come back, but who knows when.
Okay. All right. Website one more time.
At thementorpodcast.com/CostSeg, COSTSEG.
All right. Well, appreciate you, sir.
All right, Ron. I appreciate you too. You have a great one.
Great information. Thank you.
Okay. Bye.
That's all for this edition of the Mentor Podcast. To connect with Ron and learn how you can attain financial freedom, as well as up-to-date strategies to grow and protect your wealth based on today's discussion, go to www.connectwiththementor.com.